In January 1979, silver traded at $6 an ounce. By January 17, 1980, it traded at $50.50, 8 times up in 12 months. Then on March 27, 1980, a day the commodity market would name Silver Thursday, silver closed at $10.80, 79% down in 10 weeks. 2 Texas brothers had tried to corner the world's silver supply. The exchanges changed the rules, and the Federal Reserve organized the bailout. Nelson Bunker Hunt and William Herbert Hunt were the sons of H.L. Hunt, the East Texas oil tycoon who had built one of America's largest privately held fortunes. By the 1970s, the family controlled Placid Oil and roughly 30 other entities. Their combined net worth ran into the multi-billion-dollar range. In 1973, Bunker Hunt began accumulating silver at roughly $2 to $3 an ounce. His thesis combined 3 arguments. The 1971 Nixon shock had ended dollar-gold convertibility, suggesting hard asset hedge demand. Silver had historical monetary base role and was structurally undersupplied for industrial demand in photographic film and electronics. And silver was unusual among commodities, physically corner-able due to limited mine supply and slow refinery throughput. By 1979, the Hunts had moved from straight physical bullion accumulation to a combined strategy: physical silver stored offshore, plus long futures contracts on the COMEX and CBOT, contracts that required physical delivery. The architectural insight was specific: if held positions exceeded the available deliverable supply, the exchanges would either have to deliver at any price or break their own rules. Either outcome would benefit Hunt Longs. By end December 1979, the Hunts in a separate group called Conti combined held positions amounting to 50% or more of deliverable silver stocks in COMEX licensed depositories. Their March 1980 long futures alone reached 122% of total silver stocks in those depositories. The long futures position alone exceeded the available physical supply. By design, the price arc accelerated as the corner closed in. January 1979, about $6 an ounce. September, $11. End of December, $34. January 17th and 18th, 1980, peak $50.50, roughly 8 times in 12 months. In parallel, Paul Volcker, Federal Reserve Chairman since August 1979, was tightening U.S. monetary policy against inflation. The federal funds rate moved from 11.75% in January 1980 to 20% by April. Rising rates made the Hunts' margin debt servicing prohibitively expensive at exactly the wrong moment. The exchange response was structural and explicit. On January 7, 1980, COMEX imposed speculative position limits, 10 million ounces per trader, 2,000 contracts. Positions exceeding the limit would be liquidated by February 18th. Mid-January, the Chicago Mercantile Exchange enacted Silver Rule 7 stringent margin restrictions on long silver futures purchases. Then, on January 21st, COMEX moved to liquidation-only trading. No new long positions allowed. Existing longs could only sell. The corner architecture required adding positions to defend prices. The exchanges made that impossible. The Hunts could only sell into a falling market. Quick pause. This episode is sponsored by a private community I run. It's a room of peers, investors, operators, analysts, stress testing each other's thinking on industrial commodities, corporate finance leverage, and the structural mechanics of every market cycle we cover. If watching two brothers accumulate 122% of COMEX silver made you wonder what the actual mechanics look like, That's the inside. Link is in the description below. Now, back to the Cascade. The descent compressed. Late January shot silver around $35, late February quote $20. Mid-March, about $21 after a brief bounce. Then on March 27, 1980, the price closed at $10.80, 79% down from peak in 10 weeks. That morning, the Hunt brothers had failed to meet a $100 million margin call to brokerage Bache Halsey Stuart Shields. The cascade that followed had 3 steps. Step 1. Bache faced potential default on Hunt-related contracts. Step 2. Bache itself had borrowed against client accounts to finance the Hunt margin. Step 3. If Bache defaulted, the broker-dealer system faced cross-default risk that could spread. Bunker Hunt would later be asked in a 1985 UPI interview about his losses. His answer was 9 words long. $1 billion ain't what it used to be. In April 1980, Federal Reserve Chairman Paul Volcker brokered a $1.1 billion bailout loan. The lender, a 13-bank consortium, led by Bank of America and Citibank. The borrower, Placid Oil, the Hunt family oil company. The term, 9 years. The collateral, mortgages on Placid properties plus virtually every other Hunt family asset. Volcker's rationale to Congress in May was direct. If the Hunts could not meet their margin obligations, American banks and brokers would face cascading defaults. The panic might spread through the financial system. The Federal Reserve was bailing out 2 private speculators to protect the broker-dealer system that had financed them. The personal consequences played out over 9 years, 1985 and 86. IRS judgments against the Hunts for unpaid taxes on silver-related gains. 1988, Bunker and Herbert Hunt filed personal bankruptcy. 1989, a civil jury in the Minpeco case, brought by a Peruvian state mining company, found the brothers liable for manipulating silver prices. Combined estimated family losses ran between $1 and $1.7 billion. The regulatory legacy was more durable than the bailout. In 1980, the CFTC formally proposed position limits for all commodity futures. Through the early 1980s, CFTC investigations and civil prosecutions ran in parallel with the bankruptcy proceedings. The position limits framework that emerged from 1980 silver remained the foundational regulatory architecture for U.S. commodity futures through the 2010 Dodd-Frank reforms. The bailout was a one-time rescue. The position limits were permanent. The pattern is older than the Hunts. 4 Commodity Corner episodes across 153 years tell the same story. September 24th, 1869. Jay Gould and James Fisk's attempted gold corner on the New York Gold Exchange. Same architecture, accumulated long positions plus cultivated political protection from President Grant. The U.S. Treasury sold $4 million of gold from reserves and broke the corner. The day was called Black Friday. A generation of speculators was wiped out. July 2010. Anthony Ward and Armajaro Holdings took delivery of 240,000 tons of physical cocoa from London ICE futures, 7% of global annual production. The price spiked to a 33-year high. No formal exchange intervention. The position unwound over months. March 8, 2022. Tsingshan Holdings' short position on LME nickel was squeezed in a single day. The price doubled from $50,000 to $100,000 per ton intraday. The London Metal Exchange suspended trading and canceled trades retroactively. The most controversial single rule change in modern commodity exchange history. It mirrored the 1980 COMEX action, 42 years later. The structural pattern across all 4. Large private accumulation of futures plus physical. Position exceeds orderly deliverable supply. Price spikes through the squeeze phase. Exchange intervenes, changes the rules mid-game. Unwind, cascade, and margin call defaults. Regulatory or settlement aftermath. When private accumulation threatens orderly delivery, exchanges will change rules to break the corner. The Hunts encountered this wall. So did Armajaro, so did Qingshan. In 1973, Bunker Hunt began buying silver at $2 an ounce. By January 1980, he had pushed it to $50. By March, he was facing a $100 million margin call he could not meet. And the Federal Reserve was organizing a $1.1 billion consortium to keep the broker-dealer system intact. The corner architecture is the same in 1869, 1980, 2010, and 2022. Exchanges change the rules every time. Every market crash has a pattern. Here it is.